Right now, the same ounce of silver costs more in Shanghai than it does in New York. Not a little more, significantly more. Enough to cover shipping, insurance, conversion costs, and still leave profit for traders willing to drain Western vaults and send that metal east. This isn't market noise. This is the physical market screaming that China needs silver immediately, whatever the cost. In 2024, global silver ran a deficit for the third consecutive year. Industrial demand hit near record levels. Solar panels, electronics, electric vehicles, data centers, all consuming silver faster than mines can produce it. Then, the United States government quietly added silver to its 2025 critical minerals list. The same designation that changes trade routes overnight and turns ordinary commodity flows into strategic national security assets. And here's what should terrify you. When Shanghai consistently outbids New York for the same metal, arbitrage traders start draining Western warehouses to satisfy Eastern demand. But there's a limit to how much real silver actually exists in those warehouses. And when that limit gets tested, the paper system's last defense becomes accounting tricks and rule changes designed to hide the fact that promises have replaced metal. The global silver market is experiencing something that should not exist in a properly functioning commodity system. The same ounce of metal trading at meaningfully different prices in major financial centers. When Shanghai consistently pays more than New York for identical silver, this represents far more than temporary market inefficiency. It signals a fundamental fracture between paper pricing mechanisms and physical metal availability. A divergence that exposes the vulnerability of Western monetary authorities, who have long treated silver as a manageable, liquid commodity rather than the strategic industrial input it has become. This price differential is not theoretical. Professional arbitrage traders measure it daily by converting the Shanghai Futures Exchange silver benchmark from renminbi per kilogram to dollars per ounce, then comparing that figure against COMEX and London pricing after accounting for shipping, financing, insurance and conversion costs. When the Shanghai price exceeds Western benchmarks by enough to cover these transaction expenses plus a profit margin, metal begins flowing eastward through documented trade channels. The persistence of this premium indicates that Chinese buyers consistently value immediate physical delivery more highly than Western markets price the same metal, creating a sustained arbitrage opportunity that pulls silver inventory from west to east. The structural foundation supporting this price divergence lies in silver's transformation from a monetary metal to an indispensable industrial commodity. Modern silver consumption spans solar panel manufacturing, electronic components, electric vehicle systems, and data center infrastructure. These industrial applications consume silver irreversibly, unlike investment demand, which can reverse during economic cycles. Global silver markets have registered deficits for 3 consecutive years through 2024, with industrial demand approaching historical peaks, even as mine production growth remains constrained by geological and economic realities. This supply-demand imbalance creates the underlying tension that manifests as regional price premiums when certain markets experience acute scarcity. The strategic dimension amplified in 2025, when the United States government formally designated silver as a critical mineral, joining a list of materials deemed essential for national security and economic competitiveness. This classification fundamentally alters how governments, corporations, and financial institutions approach silver procurement and inventory management. Critical mineral designations trigger preferential trade policies, strategic stockpiling initiatives, and supply chain security measures that transform ordinary commercial transactions into geopolitical calculations. When silver receives this designation, its market behavior shifts from pure commodity dynamics toward the strategic resource category, where price discovery becomes subordinated to availability assurance. The Shanghai premium phenomenon represents the visible manifestation of this strategic shift. Chinese industrial capacity requires massive silver inputs to maintain production schedules for solar installations, electronics manufacturing, and electric vehicle assembly. When domestic Chinese silver availability tightens relative to this industrial demand, local prices rise above international benchmarks as manufacturers compete for limited supplies. This premium creates powerful economic incentives for international traders to source silver from Western markets and ship it eastward, effectively using Shanghai's higher prices to drain inventory from London and New York warehouse systems. The critical insight emerges when examining what this arbitrage process reveals about Western silver availability. If London and New York possessed abundant silver inventories relative to demand, Shanghai premiums would quickly disappear as increased supply flows eastward to capture the price differential. The persistence of these premiums suggests that Western silver inventories are not as abundant as official warehouse statistics might indicate, or that much of the reported inventory exists in forms that cannot be easily mobilized for international arbitrage. Understanding this dynamic requires examining the accounting mechanisms that create the illusion of abundant Western silver supplies, while physical metal flows steadily toward the highest bidder. Backwardation represents one of the most revealing signals in commodity markets, yet its implications are systematically downplayed by financial institutions that benefit from price stability narratives. In normal market conditions, commodity futures contracts trade in contango, meaning prices for future delivery exceed spot prices by amounts that reflect storage costs, insurance expenses, and financing charges. This upward-sloping price curve acknowledges the real-world costs of holding physical inventory over time. When this relationship inverts into backwardation, with near-term contracts trading above deferred contracts, the market is effectively paying a premium for immediate access to physical metal rather than accepting promises of future delivery. The mechanics of backwardation reveal urgent supply conditions that paper markets struggle to mask. When Shanghai silver futures consistently trade above London or New York equivalents after accounting for conversion and shipping costs, this cross-market backwardation indicates that Chinese buyers prioritize immediate physical possession over cheaper future promises. Professional arbitrage traders monitor these spreads by converting Shanghai futures exchange prices from renminbi per kilogram to dollars per ounce, then comparing against COMEX futures after factoring transportation, financing, conversion, and insurance expenses. When Shanghai premiums exceed these transaction costs by meaningful margins, arbitrage opportunities emerge that pull physical silver eastward from Western depositories. The persistence of backwardation signals distinguishes temporary supply disruptions from structural scarcity. Healthy commodity markets experience brief backwardation episodes during harvest delays, transportation bottlenecks, or seasonal demand spikes, but these conditions normally resolve as inventory buffers restore balance. When backwardation reappears repeatedly or persists for extended periods, it indicates that inventory buffers have been depleted beyond their capacity to absorb demand fluctuations. The silver market has exhibited these persistent backwardation signals across multiple timeframes and geographic regions, suggesting that global silver inventories may not possess the depth that official statistics suggest. Cross-market premiums amplify backwardation signals by revealing regional supply imbalances that arbitrage cannot quickly resolve. Unlike electronic financial instruments that settle instantly across global networks, physical silver arbitrage requires navigating bar standards, assay certifications, shipping schedules, customs procedures, and regulatory approvals. These friction factors create time delays between price signals and physical delivery, allowing premiums to persist even when arbitrage opportunities are recognized. Shanghai's consistent premium over Western silver prices indicates that Chinese demand exceeds locally available supply by margins large enough to justify accepting these transaction costs and delays. The broader implications of sustained backwardation extend beyond silver markets into the structural integrity of commodity price discovery mechanisms. When physical markets consistently price immediate delivery above future promises, it suggests that market participants have lost confidence in the financial system's ability to deliver real assets when demanded. This confidence erosion typically emerges gradually as inventory buffers shrink and delivery failures accumulate, forcing market participants to prioritize possession over paper claims. The silver market's backwardation patterns mirror similar developments that preceded delivery crises in other strategic commodities, indicating that current pricing mechanisms may not accurately reflect physical availability. Understanding backwardation requires recognizing its function as an early warning system for commodity market stress. Financial institutions and exchanges possess sophisticated tools for managing paper obligations through netting, rolling, and cash settlement mechanisms. But these tools become inadequate when physical demand exceeds available inventory. Backwardation represents the market's method of rationing scarce physical supply through price rather than through administrative allocation, creating economic incentives for holders to release inventory to the highest bidders. When these price signals persist, despite arbitrage activities, they indicate that the physical commodity has become genuinely scarce relative to financial claims, transforming backwardation from a temporary anomaly into a structural feature that reflects underlying supply-demand imbalances. The modern silver market operates through accounting mechanisms that systematically obscure the distinction between metal ownership and metal availability, creating statistical illusions that mask genuine scarcity until physical demands force uncomfortable revelations. Scarcity in contemporary precious metals markets does not begin when global production fails to meet consumption, but rather when available metal supplies cannot satisfy immediate delivery requirements, regardless of how much metal exists in various accounting categories that appear liquid, but function as frozen assets when tested by actual demand. London bullion banking exemplifies this illusion through its fundamental distinction between allocated and unallocated silver accounts. Allocated accounts represent specific bars with defined serial numbers, assay certificates, and vault locations, functioning as genuine ownership of identifiable physical metal. Unallocated accounts operate as bank deposits, representing claims against a general pool of silver, without designation of specific bars or guarantee of immediate availability. The vast majority of London silver trading occurs through unallocated accounts, which provide price exposure and paper liquidity while requiring significantly less physical inventory than the trading volumes might suggest. When unallocated account holders demand physical delivery, banks must source actual bars from their allocated inventory or purchase metal in spot markets, potentially triggering supply shortages if multiple clients simultaneously exercise delivery options. The COMEX warehouse system employs parallel accounting categories that create similar availability illusions through its eligible versus registered classifications. Eligible silver meets exchange specifications for quality, weight, and form, but remains privately owned and unavailable for delivery against futures contracts. Registered silver represents the pool explicitly designated for potential delivery to futures contract holders, functioning as the critical inventory buffer that supports the exchange's delivery obligations. The registered category typically represents a small fraction of total COMEX warehouse holdings, meaning that headline inventory figures dramatically overstate the silver actually available for contract settlement during delivery periods. Recent warehouse data reveals the vulnerability of these accounting distinctions when physical demand intensifies. Shanghai silver inventories experienced substantial drawdowns through 2024, including periods of steep weekly outflows that reduced warehouse stocks to multi-year lows, demonstrating how quickly available inventory can disappear when industrial and investment demand converge. London Vault statistics continued displaying impressive total holdings, but much of this metal remained locked in exchange-traded fund allocations or private storage arrangements that remove it from active trading consideration. COMEX registered inventories fluctuated dramatically as metal moved between categories or departed entirely for higher-priced destinations, revealing how thin the actual delivery buffer becomes when arbitrage opportunities emerge. These inventory illusions force profound changes in market behavior when physical tightness emerges. Silver lease rates and borrowing costs escalate when good delivery bars become scarce, reflecting the premium required to source actual metal rather than paper claims. Price spreads between different contract months, delivery locations and settlement mechanisms begin exhibiting unusual patterns as the market struggles to maintain the fiction of abundant supply. Exchanges and bullion banks increasingly rely on exchange for physical transactions, cash settlements, netting arrangements, and position limit adjustments because moving actual metal becomes more difficult and expensive than manipulating paper obligations. Understanding these mechanisms reveals how inventory statistics can appear reassuring, while physical availability approaches critical thresholds that threaten the stability of paper-based pricing systems. Historical precedent demonstrates that precious metals markets operate under the illusion of free price discovery, until strategic concerns compel authorities to implement control mechanisms, revealing consistent patterns of intervention that transform during periods when physical demand threatens established monetary arrangements. The London Gold Pool provides the clearest example of coordinated official intervention designed to maintain artificial price stability when market forces threatened existing monetary frameworks. Between 1961 and 1968, major central banks cooperated to defend the $35 per ounce official gold price by pooling resources and coordinating sales whenever market demand pushed prices toward uncomfortable levels. This arrangement functioned effectively while participating central banks possessed adequate gold reserves to overwhelm private demand, but ultimately collapsed when French gold purchases and escalating Vietnam War expenditures created supply pressures that exceeded the pool's collective inventory capacity. The system's breakdown forced emergency market closures and precipitated the fundamental regime change that terminated gold's official monetary role, demonstrating how price control mechanisms work until physical demand overwhelms available stockpiles. Silver Thursday in 1980 provides equally instructive evidence of how exchanges modify rules during crisis periods to ensure preferred outcomes, regardless of underlying market dynamics. The Hunt brothers' attempt to accumulate massive silver positions drove prices from approximately $6 per ounce in early 1979 to over $50 by January 1980, creating systemic concerns about market stability and financial institution exposure. COMEX responded by implementing emergency rule changes that restricted new long positions while permitting unlimited short selling, effectively forcing liquidation of existing positions through margin pressure and regulatory coercion rather than allowing natural price discovery. The subsequent price collapse demonstrated how exchanges function as crisis management tools rather than neutral price discovery mechanisms, employing rule modifications, margin adjustments, and position limits to achieve stability objectives when market forces threaten established order. Contemporary regulatory enforcement actions provide documented proof that sophisticated market manipulation continues in modern precious metals trading, destroying any pretense that current prices reflect genuine supply and demand dynamics. Multiple major banks paid substantial penalties between 2020 and 2022 for precious metals manipulation, including systematic spoofing operations that created false price signals through coordinated placement and cancellation of large orders designed to influence market direction. These enforcement actions revealed manipulation techniques involving thousands of fraudulent orders over extended periods, indicating that price control efforts represent standard operating procedures rather than isolated incidents. The regulatory record demonstrates that major financial institutions actively manipulate precious metals prices through sophisticated techniques that create artificial price stability while extracting profits from information asymmetries. These historical patterns reveal the consistent methodology employed when precious metals markets threaten financial stability or monetary policy objectives. Authorities do not announce direct price control programs, but instead implement indirect mechanisms including coordinated central bank actions, emergency rule modifications, enhanced margin requirements, position restrictions, and enforcement discretion that collectively steer prices toward acceptable ranges. Understanding these precedents illuminates why current silver market dislocations represent familiar early warning signals rather than unprecedented developments, suggesting that official responses will follow established patterns of increasing intervention as physical shortages challenge paper market stability. The contemporary silver crisis emerges from the convergence of three irreconcilable forces that create an inevitable trajectory toward market breakdown, regardless of official attempts to maintain stability through paper mechanisms. Structural demand continues grinding upward as solar panel installations, electronic device manufacturing, electric vehicle production, and data center expansion consume silver at rates that exceed historical precedent, while these industrial applications destroy the metal permanently rather than creating recyclable inventory that could buffer future shortages. Supply constraints persist as global mine production growth remains limited by geological realities, permitting delays and capital allocation decisions that prioritize immediate returns over long-term capacity expansion, creating supply elasticity that cannot respond rapidly to price signals. Strategic policy considerations intensified dramatically when the United States designated silver as a critical mineral in 2025, transforming ordinary commodity flows into national security calculations that prioritize supply chain resilience over economic efficiency. China's aggressive silver acquisition represents rational strategic behavior rather than speculative excess, reflecting the logical response of the world's dominant manufacturing economy to supply security concerns that threaten industrial continuity. When Shanghai consistently outbids Western markets for physical silver, Chinese buyers demonstrate their willingness to pay premium prices for immediate delivery rather than accepting cheaper future promises that may prove worthless during supply disruptions. This behavior intensifies global tightness by creating sustained demand for Western inventory through arbitrage channels, effectively using price premiums to drain silver from London and New York depositories, regardless of official resistance or intervention attempts. The predictable progression toward market breakdown follows recognizable stages that repeat across different commodity crises when physical scarcity challenges paper abundance illusions. Stage 1 manifests as persistent premiums and recurring backwardation episodes that signal underlying supply stress, despite official inventory statistics suggesting adequate availability. Stage 2 emerges when borrowing costs and lease rates escalate sharply as good delivery bars become increasingly difficult to source, forcing market participants to compete aggressively for diminishing physical supplies. Stage 3 arrives when exchanges and bullion banks implement emergency measures, including enhanced netting procedures, expanded exchange for physical mechanisms, inventory reclassification schemes, position limit modifications, and margin requirement increases designed to reduce physical delivery pressure through regulatory coercion. Stage 4 represents complete divergence between paper prices and physical availability, creating parallel markets where coins, bars, and industrial quantities trade at substantial premiums to exchange-quoted prices, while delivery becomes the primary battleground rather than price discovery. This progression represents the physical market's systematic rejection of paper supply comfort narratives, forcing recognition that price and availability constitute entirely different concepts when scarcity emerges. Shanghai's premium signals the beginning of this process rather than its conclusion, indicating that the physical market has begun voting against Western paper mechanisms through sustained higher prices that reflect genuine supply constraints rather than temporary market inefficiencies. Understanding these signals provides advance warning of the inevitable moment when paper promises and physical reality diverge completely, transforming silver from a manageable commodity into a strategic asset where possession becomes more valuable than price exposure.